I want to explain to you why I really enjoy trading with the main currency strength and weaknesses each day. Let me share more details with you right now. Hi traders, it's Andrew Mitchem here from the Forex Trading Coach, and today is Friday the 6th of June. And I want to talk about currency strength and weakness. You see, for me it's something that's quite important. It plays an important part of my daily trading routine. And I'd like to share with you the reasons why. Because to me it's quite a logical thing. If a particular currency is looking very strong and it's looking strong against all other currencies, and you then have another currency that's looking very weak and that's looking particularly weak against all or most other currencies, it seems logical to be trading in the direction of that pair. When you put the two together, you take your strongest currency pair or your strongest currency and your weakest currency. Let's say the strongest currency is the euro and the weakest currency is the US dollar, as an example. Put the two together, it makes sense for today to trade as looking for buy trades on the euro US dollar. Now, a few days' time, we might find that, let's say, for example, the same two, you might find that next week the US dollar might be looking really strong and the euro is looking really weak. Again, put the two together and it makes sense for that day and the upcoming day to be looking for short positions on the euro US dollar, because your main dominant strength at that time, or your main dominant direction, is for the euro US dollar to be falling. So to me it makes logical sense. Well, so that's fine, but how do we sort of use it, I suppose, and what advantages does it give us? Well, to me it helps keep me on the right side of the likely direction for that upcoming day. So go back to the example again. Let's say the euro is looking strong, the US is looking weak. For today, I'm looking at predominantly buy trades only on the euro US dollar. And again, what does that do for me? Well, it keeps me on the right side, of course, of where I'm assuming or I'm looking for that currency to go. But what it also does is it helps me with confidence. It helps me with not taking short positions on that pair for the day. Let's say that the euro US is going up really nicely and I haven't taken any trades. I've either missed them or haven't seen any. It's gone up nicely, but then it pulls back. Now, a lot of people might be taking sell positions on that euro US dollar, but I'd prefer to leave those setups. I might see a really good sell setup, but because my main dominant strength for that day is for buy trades, I'm ignoring the sell setup. I'm letting the sell position or the retracement, the sell-off happen, and I'm much preferring to then wait for bullish candles and buy setups in order to jump in at a lower price, at a better price, and then ride the euro US dollar back up again after it's had its retracement. Because don't forget, no currency just does that. Nothing goes up in a straight line or a 45-degree angle line. Everything moves up and down. It moves up, it pulls back. It moves up, it pulls back. It moves up, it has a bigger pullback sometimes. But altogether, it's still moving up, but it may move up and then retrace many, many times within that overall uptrend. The other scenario is, let's say I'm looking for buy trades on the euro US dollar, and I don't see any. And the euro US dollar just sells, sells, sells. It just keeps falling all day. What does it mean for me? Well, most importantly, it means I probably haven't entered any buy trades because I haven't seen any. So if I haven't seen any, I haven't entered any, it means I haven't lost anything. So that's another good aspect to having your sort of anticipated direction based on logical reasons. If that doesn't come through, and of course it doesn't come through every day, no one gets it right all the time, but if it does end up completely against your anticipated direction for the day, you just generally find that there are very few or no good setups in your ideal direction. That's fine. It just means you just don't take any trades, and like I said, you don't lose. So the great thing with that is it's not like you're taking lots of you're taking lots of buy trades just because you think it's going to go up. You can't do that. You can think and have logical reason that it's going to go up, but if it doesn't do that, then you just don't take any trades because they don't show. So I hope that clarifies it, and I also hope it clarifies the reason why, for me, understanding the likely direction for a pair for the day is such an important aspect of my trading. Now, today being the first Friday of the month, we have the US non-farm payrolls or non-farm employment change data coming out of the US. It's expected to generate 214,000 jobs. Last month was 288,000. I would be anticipating that the number's going to come out less. That would be my my feel for now, and that's based on the fact that I see some weakness today, being Friday, in the US dollar. We've got almost another 12 hours from when I'm recording this right now until the release of the non-farm payroll, so it's quite hard to say for sure, but right now to me the US is looking a little bit weaker for today. Therefore, if that continues, it's likely that the employment figure should come out lower than forecast. So by the time you watch this, you'll know the answer and you'll see whether I've picked that correctly or not. Either way, I'm not a news trader, so I won't be actually watching the charts or taking any positions based on that news. Anyway, it's just something to be aware of. And more importantly, as a technical trader, it's important to be aware of those higher impact news announcements, such as the non-farm payrolls, because for me, I want to have all my trades on a daily chart and down closed before that announcement. If I have charts or trades open off the monthly and weekly charts, I'll let them stay in the market over that news announcement, but everything else I'll probably either have it closed or certainly close part of the position or manage the trade, such as moving stop losses, etc. Because with those high impact news announcements, anything could happen and the market can spike or the spreads could widen, and it's just really hard to control your position over that news announcement. So the easiest thing is just to close out before that. Other thing I wanted to mention, if you haven't yet got my lot size calculator, make sure you get it. There is a free download on my website. I just, all the time, day after day, week after week, I get just emails back from people just really appreciating how simple to use, but how effective that lot size calculator is. It works on the MT4 platform and it helps keep your position size equal per trade, and it makes you forget about how many pips you make, because it really doesn't matter. It's the risk that you take on a trade as opposed to the risk or the gain you make on a trade. So it's the risk as opposed to the gain. The reward to risk of a trade that's much more important than wondering how many pips you make. I've never yet been to a shop and spent pips, but when I'm making a percentage gain on my account, I can certainly take that money and go and spend it. So that pretty much sums up why I'm a firm believer in not trading with pips. So I hope you have a fantastic weekend. Look out for that non-farm payrolls. Just keep an eye on it and make sure it doesn't affect any open positions. And I look forward to talking to you this time next week. This is Andrew Mitchem from the Forex Trading Coach.